Inc. trades on the OTC Pink sheets under the symbol EGYF and is a leading off-grid renewable energy innovation company committed to developing groundbreaking technologies today that will make a significant impact on tomorrow's society. Please welcome Kevin Pivonski, the President of U.S. Operations. Excuse me, Keith Pivonski, President of U.S. Operations. Welcome to the conference today. We're looking forward to your update.
Good afternoon, Anna, and thank you for inviting me and having us back on. We're excited to provide some updates today. And as you said, my name is Keith Pivonski. I'm the President of U.S. Operations at EGYFEnergy, Inc. And over the next 8 to 9 minutes, I'll be providing a focused update on who we are, what we're building, and why now is the time to invest. I'll also do my best to leave a few minutes for questions at the end. And with that, let's begin. EGYFEnergy is an emerging growth company focused on energy and environmental technologies capable of scaling globally. We operate at the intersection of energy, environment, and data infrastructure sectors, industries that are worth over $1 trillion when combined. Think of us as a next-generation company like Martin Marietta or Clean Earth, but with deeper integration across science, smart materials, and collaborative technologies. We help large corporations unlock unrealized synergies in their waste, water, and energy operations. As I dive into today's presentation, I wanted to start with lining up several of our value-creating milestones and future catalysts. I recognize a lot of companies would do this at the end, but if you're not interested in the catalysts that we're working on right now, then you probably aren't interested in the rest of our presentation. First off, just last night, we were formally accepted into the Greater Washington Partnership Accelerator hosted at Deloitte's Roslyn, Virginia location. This places EGYFEnergy in direct collaboration with executives from Deloitte, Dominion Energy, Exelon, and Kaiser Permanente, giving us access to top-tier minds and potential enterprise partners. At the same time, we're closing our strongest revenue quarter in recent company history, dating back to when we were trading under OPTQ on the NASDAQ some 20 years ago. We're now on track to complete 2 years of audited financials to file the 15C211 form and Form 10 registration, which will unlock broader access to capital markets moving forward. Finally, we're planning investor roadshows, private placements, and long-term shareholder value strategies that include stock buybacks and dividends. So what are some of the problems EGYFEnergy is addressing today? Number one, close to $5 billion is spent every year by utility power companies just to manage coal ash and the combustion residuals from large power plants. Roughly 90% of retired coal plants are leaking contaminants into fresh groundwater supplies every day. And through our customer discovery process, we've learned that a typical data center uses 1.5 million gallons of fresh water every single day. We see these not just as problems, but as powerful market entry points where energy, waste, and water challenges converge. Our business plan and current offering is very clear. In phase one, we will resell high-volume byproducts like CCRs and select soils into regulated reclamation markets. In phase two, we will acquire abandoned or underutilized land and reclaim it using those same byproducts on a site that is owned and operated by EGYFEnergy. In phase three, we will install revenue-generating clean infrastructure such as solar, water management, and AI-powered data nodes on top of these restored sites. In plain terms, we aim to turn waste into cash flow and vacant land into long-term profit centers. Today, we're operating in phase one currently. We've built a lean team of 3 full-time staff members, 2 part-time, and 4 subcontractors. We're already seeing strong traction after 90 days of operating under this new business model, projecting 50% gross margins and 20% net profit in Q4 through March 31st. We are OTC Pink current, and we expect to uplist after completing audits and filings in the next 60 days or so. Our roadmap forward is as follows. In 2025, we aim to double our revenues, surpass $500,000 in sales, and uplist to the OTC QB market. In 2026, we'll enter phase 2 within land reclamation and restoration projects, aiming to surpass 1 million in revenue and to ramp up investor awareness similar to our anticipated future peers on the NASDAQ market. As we enter phase 3, we plan on deploying the eBox technology previously cited at our last presentation and various other smart infrastructure-based technologies on restored lands, targeting $2 million in sales and a market cap that warrants itself to be NASDAQ listed going forward. Our goal is to position ourselves for a NASDAQ uplisting within 2 years, not through speculation, but by creating real-world environmental and digital infrastructure assets. Sorry about that. Looks like one of my slides came through out of order. Unlike traditional companies siloed in one sector, Energy Finders aims to connect the dots across various industries. We work within logistics, materials, utilities, and smart infrastructure. Where other companies see waste, we see value. Where others see contamination, we see opportunities for clean growth. And we recognize that over 450,000 brownfield sites currently exist in the United States, such that it is likely going to take a multi-generational approach to combat this growing crisis within both real estate and the greater US economy. Our current ask, so why are we here today at the Emerging Growth? The short answer is to prove awareness around our stock and to invite accredited investors, retail investors, and other like-minded capital markets-focused individuals to reach out to us and to engage in a productive dialogue that will hopefully bring benefits to both parties long-term. We're currently set on raising $1 million to scale our proven phase 1 business to $5 million in annual reoccurring revenue. Our anticipated use of the funds that we anticipate to raise is $320,000 to acquire 2 steel body dump trucks, $250,000 for legal, accounting, payroll, marketing, and stock promotion, $150,000 for the acquisition of abandoned reclamation site, and approximately $280,000 in cash reserves and operating capital. I want to be clear that we're not asking investors to take a leap of faith. We're asking them to accelerate a plan that's already moving quite rapidly over the past 90 days. It's not often that a company can go from $10,000 in sales over 3 years to $100,000 in sales in less than 3 months, but that is what we've achieved at Energy Finders over the past 11 weeks, and our audited financials will prove that once they are filed. In closing, I'd like to say that Energy Finders is uniquely positioned to align environmental, energy, and data infrastructure into a profitable, scalable platform on former reclamation lands. We are early, we are moving, and we are building something very real. Thank you, and at this time, I'd be happy to open up the floor to any questions.
All right, excuse me, great job. We do have a few minutes for questions. Is there any risk to the surrounding residential areas by building plants where you are? And are there any municipal hurdles that have to be overcome?
I think there's always risks. We learned through our first pilot site that there's pros and cons to being adjacent to small communities, elementary schools, and potential offtake customers. I would say that most of the land sites that we're looking at are in more remote areas that are less rural going forward and a much larger scale than the first site that we acquired. The first site we're working on in Baltimore is only a ½ acre in size, but the sites that we're targeting for future development for this much larger reclamation model really begin at 30 to 50 acres in scale. And so most of those do not have communities directly adjoining them, and they're really a little further removed from the greater populace.
And Ron is asking, is the stock quoted? Is there a 15C 211 that needs to be filed?
It does need to be filed. We used to have a lot more market makers before the rule changed for the OTC markets in September of 2022, I believe. And so we now need to reapply with that Form 15C211 to enable those proprietary broker-dealer quotes and to gain back the 11 to 12 market makers that we had prior to the rule change. So yes.
Talk a little bit about the grants as they're related to stock dilution. When will you have updates on them?
So we applied for 2 grants last year, and we were told in both cases that we needed to reapply this year because although our proposition was very competitive, they were funding the previous year's folks that were moved into the next year. And likewise, our proposition from last year would be a top priority for this year. So I think you're a lot more likely to see grants awarded to energy finders in 2025 based on the groundwork we did in 24. But we're no longer counting on grants or investor funds to grow this business. We will utilize our own cash flow. We have net income for the first time in over 20 years, and we will leverage that to grow this business regardless of whether we're successful or not with grants or raising outside capital.
Great. And so what do you need immediately to ramp revenue?
Ideally, we would raise $500,000 to $1 million to achieve the 4 things we showed in one of the prior slides, which really just grows out our balance sheet and enables us to deliver on contracts that right now we don't have the capacity to deliver without growing out our own infrastructure internally. We would like to see, 3 dump trucks on the road and, the ability to move upwards of a few million cubic yards of material per year within the next 6 months if we complete the cap raise.
And what phase of development is EBOX?
I would say it is TRL 5 and 6 right now. The best piece of information that I can share is that when you concentrate photons or solar cells, it brings in a risk that you don't normally have to encounter with traditional solar panels on let's say, the rooftop of your home. The concentration of natural sunlight that hits the rooftop of your home is much different than concentrated light. And so as we're working through testing and we're realizing the results of concentrating light, we're seeing damage to the solar cells at a faster rate than you typically would see outside. And so it's up to us to come up with smart materials and internal properties of materials that will coat the cells that will prevent that degradation from happening like we're seeing in testing. So I think for investors, the greatest risk for EBOX will be how does Energy Finders eventually overcome that thermal damage in order to have a product that lasts the same or longer than the traditional panels that go on your home.
All right. Well, perfect. Keith, thank you so much for this update. Congratulations. And we look forward to seeing you again real soon.
I appreciate it. Thank you for your time.
All right, everyone. We'll be right back.